All right. Thank you everyone for attending this month's market update webinar for September 2024. Let's start as usual with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within this presentation. And of course, past performance is not a guarantee of future results. Throughout the webinar, please use the Q&A button to submit any questions you may have. I'll address them at the end. A quick bio about myself. I'm a certified financial planner, certified private wealth advisor, accredited investment fiduciary, accredited portfolio management advisor, chartered retirement planning counselor, and I have my master's degree in personal financial planning. You can learn more about me on my LinkedIn. And Silverstone Financial, the firm, is a fee-only fiduciary registered investment advisory firm. We provide comprehensive wealth management services, including financial planning, investment management, and tax and estate services. You can learn more about us on our website. All right. Well, August was an interesting month. In general, it was a pretty good month if you ignore the very beginning. The first few days, I'll show you in a few slides. We had a big dip. It was like a flash sale. It had to do with Japan and the carry trade. If you want to learn more about that, it was discussed in last month's webinar, since it happened a few days before the webinar was hosted. So this month, mostly just going to cover the rest that happened. Overall, again, solid month. S&P 500 up 2%. Mega caps and Dow Jones was mostly in line. Small caps were the only equities that had a negative return for the month. It lost 1.6%. Global ex-US, so non-United States stock markets performed quite well. It actually outperformed for the month, the S&P 500 and the rest of the US equities. In general, historically, international funds, international stocks perform worse, and I still have that viewpoint, but it's good to see that they made up some of the lost ground that they had for the past year and the past 20 years. Aggregate bonds were up 1.4%, gold up 2.2%. Crude oil, again, probably one of the most volatile indices we track on this list, down 5%. It's not surprising that oil goes up and down 5% a month to month, nothing to worry about. And Bitcoin was down 10% for the month. Again, another very volatile asset class here. Has had a great entire year. If we look at just the month, it's down 10%. If we look at year to date, still up 40% for Bitcoin. Crude oil flat. Gold up 22%, one of the best investments since the beginning of the year. And the S&P 500 at 18%. You can see that of the S&P 500 in comparison to small caps, small caps only up 7%, mega caps up 23%, mostly being carried by NVIDIA and some other very large tech companies. S&P 500 has become more and more concentrated in a few very hyper mega large cap tech company stocks, and they've had quite a year. I've mentioned every single month, but NVIDIA still incredibly, it's up 114% for the year, and that's after it selling off in the past month and a half. TSM, Meta, Eli Lilly, all these mega cap names have had quite a good year so far. For S&P 500, I always like to show this graphic. It shows the seasonality or the cyclicality of the normal markets There are good months and bad months, at least historically. Again, past performance doesn't necessarily mean this was going to happen in the future. But right now, August, September is historically the worst 2 months of the year. I do expect that, especially since I'll show you in the next slide, we've kind of hit a ceiling in for the S&P 500 when we look at it from a technical standpoint, the graph. I wouldn't be surprised if we sell off at least a little bit in September, or at least we don't have significant gains. Of course, I could be wrong. The S&P 500 could keep on going up and up, but since we've had such a strong past 4 months of just constant gains, especially in months that historically don't do so hot, like August and June are normally flat or slightly negative, and in May on average doesn't perform as well as some of the rest of the months here. But we had 4%, 3%, 1%, 2% returns in a single month. Year to date, we're up 18%. Historically, the S&P 500 returns, again, on average, 8 to 10%, depending on how you calculate it. So I wouldn't be surprised if the market cools off a little bit before catching back up or continuing its run into November and December with the Santa Claus rally, the year-end rally. But for that to happen and for us to not go over our skis, I wouldn't be surprised if there's a little bit of selling off. We also see, which we'll discuss a little bit in the future slides, we see the Federal Reserve getting ready to cut rates because inflation is down, but also we're starting to have some troubles in the job market and some other economic indices, some other economic data that they like to look at. We're finally seeing some of the effects of these rate hikes, which are tightening, which hurt the economy intentionally so that inflation doesn't run rampant. So again, don't be surprised if September you hear bad headlines, but that shouldn't change your investing strategy. Investing long-term, staying in the markets, historically has shown to be the best way to invest. Don't be too emotional or too trying to time the market, jump in and out, sticking with it, even if we expect this next month to be rough or at least not as enjoyable as the past year has been. Moving on to the daily chart, I chose not to add any lines or any graphics or anything to this, mostly because I don't have much to say. Like we see since November, just a straight line up to April, and then 1 month slowing down, selling off a little bit, and then another roaring up from May all the way until July, like mid-July here. And then it sold off a little bit. And then this was the flash crash about Japan and the carry trade. Again, you can go on my YouTube if you want to learn more about that. But we sold off for 3 days really, really heavily. It was scary for quite a few people. We saw the VIX, which is the volatility or the fear index, spike up as high as some of the 2008 crises. And it was a very interesting day because just how fast things moved. And again, it had to do with traders, hedge funds, institutional companies, investment companies unwinding some of the trades that they've had for years because of changes in how international exchange rates and changes in international interest rates affect our U.S. economy and our U.S. stock market. I wanted to also point out that we were at all-time highs here in July. We sold off a little bit, then we had the flash crash, and then I would call it a flash recovery, very quick back up to this 5,600 level. And you can see it's pretty flat here. This is what we'd call a ceiling. So when you see a chart not be able to go above a certain level, that means that there's someone out there that says, well, at 5,600, I feel that's a fair price to sell my shares, and I just want to leave the market. And then someone else tries to buy more, and then another person's like, oh, we're back at, a little bit above what I'm comfortable selling at, and they sell. And based on that, we're having this, a equilibrium of buyers and sellers. And I wouldn't be surprised if the buyers start to get tired, and we see a little bit of a sell-off. We had a few bad days in the past couple days that you see right here. I wouldn't be surprised if we had a similar case to maybe April, where you see a similar ceiling. You get the candles, they're called. The candles get really short, and you start seeing like, all right, well, there might be a few bad days and then maybe a bit of a sell-off. And of course, I can't predict what will happen next, but it's natural, it's normal. You got to remember to zoom out a little bit. Even if we go down to 5,200, we have another crash down here. That's still significantly higher than where we were in July of last year at 4,400. That's still 1,000 up. So don't stress too much about the volatility of the markets, as long as you have a consistent investing strategy and you know how the rest of your finances are looking and how they're working. All right, enough with markets, enough with stocks and numbers. This is usually the more fun part of the evening, is talking about the notable events. There were 4 main interesting events that I wanted to cover. Of course, there's always more news to cover, and there's lots of news that doesn't pertain to the markets. This is specifically notable events, at least in finance. The first one I want to talk about was the SEC charging Carl Icahn with holding billions or hiding billions worth of stock pledges. So what that means is, you might have heard of these billionaires, how they avoid paying taxes. They have large sums of money that are locked in their appreciated stock shares, and they'll go and they'll pledge that against a margin loan or a collateralized loan and get the money from the bank. And since it's a loan, it's not income, they can spend it and still hold their shares without selling and incurring taxes. So I don't necessarily know Mr. Icahn's situation. I don't know if that's why he has those loans, but I wouldn't be surprised if that is the reason. But the problem is if you're a public company, you have to disclose various parts of your personal finances as a director of the company, and how large sums of these public shares are being collateralized. Assuming that he goes bankrupt, the bank will have to sell Icahn Enterprises stock, and it might affect the share price. So this is what we call material information that must be disclosed to the public. And this isn't like minor things that he had, billions in stock, but the company's worth billions and billions more, and it was only 5%. Apparently, allegedly, based off of the reporting that I saw, 50 to 80% of all the outstanding shares in Icahn Enterprises, which are mostly owned by him, he has the majority ownership, but 50 to 80% of all the shares of the company were pledged to loans. Now, if I was a shareholder and I didn't know that, that would be very material in my opinion. So seeing what has happened and seeing the SEC charge him is not surprising to me. Apparently, they settled the allegations for a $2 million fine. So for a billionaire, like in comparison to the amount of money that he has saved on taxes or whatever other strategies he's doing with his loans, $2 million fine probably doesn't affect him as much as the reputation hit from this being reported. But still, it's interesting to see Carl Icahn, which, he was a billionaire activist investor. He owns Icahn Enterprises, which is a investing conglomerate, and they would buy up shares of companies, and then they would force management to change, and that's what's called an activist investor. They're advocating change in a company to increase shareholder value or some other rationale. So historically, he was seen as somewhat of a titan of industry. However, last year, May 2023, a short seller, it's called Hindenburg Research, they're a hedge fund, I believe, they had published a research report alleging the company was doing many bad things, where they were undervaluing or overvaluing their holdings. Of course, their holdings are private companies that are hard to value, so they can kind of call what they have, or like value what they have and disclose that. They have some leeway there. They were also alleged that he had a whole lot of exactly what he was charged for here. A year later, the SEC actually charged him for it. That they had lots of outstanding collateralized loans against the shares, and other problems, essentially. Of course, it's important to remember these short sellers that publish these research papers are incentivized for the share to go down. They have taken a short position, they get money if the company falls. Now, it would be slander if it's not true, if it's found to be not true. Of course, there's fact and there's opinion and there's falsities. If it's falsities, Hindenburg Research would be liable. But it seems to be at least part of the report is true, because the SEC charged Carl Icahn and then Carl Icahn settled. I don't know if he admitted wrongdoing or if the company admitted wrongdoing or if they settled without admitting anything. But still, it's interesting to see how far this darling company, that it wasn't this large, super large company. It was worth billions of dollars, but it wasn't the largest of what they do. But it was still seen as solid, as a investor that had done great things over his career, and the tarnished reputation from this report in 2023 and then these allegations that were charged against him and settled, to me at least, it shows significant failings and significant damage to his reputation. So it doesn't affect anyone on this call. It's just an interesting story that I followed in the past month. Interesting to see when bad deeds have been uncovered over that have been perpetrated for many years. Of course, it doesn't rise to the level of like a Ponzi scheme, but still, you should disclose the required information to public markets, not break rules. In comparison, a much larger investing conglomerate would be Warren Buffett's Berkshire Hathaway. In many ways, is closer to, in my opinion, a mutual fund than any specific company. That's what a conglomerate is. They own lots of companies and own lots of shares of stock. So it's a strange company to try to value, a strange company to try to like say, oh, this like if you look at Google, I guess it's not a great example because they are a conglomerate themselves. But if you look at all the very large tech companies are usually some sort of conglomerate. But I guess NVIDIA, and that's a good example. NVIDIA, they have one main line, which is they make semiconductor chips, computer chips. And they are worth billions and billions and billions of dollars. However, Berkshire Hathaway is mostly a financial services company, a investing company. They go out and most of their money was made from insurance, but then they would reinvest the insurance proceeds to buy different companies. They have Bank of America, they have Apple shares, they have Dairy Queen. Anyway, it's interesting because it's hard to value, but Berkshire Hathaway, they were the first non-tech company in the US to hit $1 trillion. There aren't that many non-technology companies worth that much money. One of the others I can think of is Saudi Aramco, which is Saudi Arabia's government-owned oil company. That's not tech stock. But almost all the other $1 trillion companies, you got Apple, you got Meta, which is Facebook, you got Amazon, you got Google, you got NVIDIA. Eli Lilly is getting up there, which is a pharmaceutical, but they're not at $1 trillion. It's interesting to see how some of the still always massive companies, but finally hitting that $1 trillion mark. Again, it's an arbitrary mark. It doesn't matter that much to anyone on here, but still, it was big news, especially since Warren Buffett and Berkshire Hathaway is revered in the finance community as the greatest investor of all time, or at least an institution to be regarded. All right. Third topic I want to discuss was inflation and the Fed rate cuts. We officially hit 2.9 inflation reported for July, this year over year data. So we've got within the range. Of course, the Federal Reserve says their target is 2%, but most economists, most people say anywhere within between 2 and 3% is where you want to be for inflation. The Chair Powell, which is Jerome Powell, he heads the Federal Reserve, and he had finally said that the expectation is that they're going to start doing rate hikes. So it's extremely expected in the market's view that this month's Federal Reserve meeting, they will begin cutting rates. In 2023, they rose rates to constrict the economy, which helps reduce the inflation by tamping down demand. Now that we've gotten to a point where we're starting to see inflation back to where it's healthy and see some labor market trouble, you see jobless claims go up, and we've seen some other economic indicators, economic data that have cooled off and seemed less attractive, more dangerous. The fear is if you keep rates too high, eventually the Federal Reserve could push us into a recession. So that's the fear. So when they're trying to have a soft landing or threading the needle is, all right, let me raise rates to the right amount so that inflation comes down, and then let's start cutting rates at the right time with the right amount so that we still continue growing without inflation coming back, and not doing it too soon or too late where the economy would go crashing into a recession. So that's what they're attempting to do. The expectation is they're going to start slow. Most people expect a 25 basis point rate hike, or rate cut rather, this month, but it's possible they'll do a 50. And then they'll probably continue doing 25s or 50s slowly in the coming months until they hit whatever their long-term rate they're comfortable at. It'll probably be around 4%, I believe. It depends on who you talk to on the Federal Reserve, and depends on which analyst or economist you talk with. Everyone has different opinions on the neutral rate where you keep it long-term. But it'll be somewhere around 4% probably, 3.5 to 4.5, somewhere in there. I'll keep you updated next month when we hear what the Fed will do. All right, last topic for the night. It'll probably end up being a short webinar, about half an hour, but I want to talk about the Chase Bank infinite money glitch. For those of you that are on TikTok, you might have seen videos. Most of it, I saw it after, I saw people covering it. I didn't actually see the original videos before people said this was a terrible idea, but I'll give a brief overview if you haven't seen the headlines. Essentially, there was a TikTok hack that spread like wildfire, where essentially the idea was they were promoting a harmless life hack, where if you banked at Chase, what you would do is you would take your checkbook and you would write yourself $50,000, let's say, a $50,000 check. And then you go to a Chase ATM, had to be an ATM, not a teller, and you would deposit your check into your Chase bank account. And that check would deposit immediately, and you'd have instant funds available, and you would withdraw the $50,000 or however much they allow you to withdraw. And then you go spend that money, and everything was great. It was a glitch, clearly, where you deposit a check and then they allow you to take the money out, even if the money is not there. Now, of course, the next day when the check goes to clear, it fails, and then the money is reversed, but the money has been withdrawn from the account. So the checking account would then go to negative $50,000. And what's if for those of you that know financial terms or legal terms, this is what you would call check fraud. Classic check fraud, which was done back in the day before computers. It was a classic grift or whatever you want to call it. So it got popularized to do this on TikTok, and it, like, a lot of people that were financially illiterate, at least in some ways, didn't know that this is just clear fraud, where you go and you say, well, oh, I thought I'm allowed to do this because everyone's doing it. And there were pictures where people were lining up at ATMs to try to do this. And it's sad because a lot of these people, there were some bad actors, absolutely. And you shouldn't publish these things if you don't know what you don't know. So the content creators that were recommending you do this, that is terrible. But for those that truly didn't know, that were just like, oh, well, I saw this on TikTok and you went to go do it, it's kind of sad when you think about it, because they did it in a way, like, I'm not advocating if you're going to do a crime, do it in a way you don't get caught, but it's very clear that if you go to your checking account, it's your checking account. They have your name, your social security number, your address, your email, your phone. All right. And you just clearly, blatantly commit fraud, and then you're still owed the money. So usually they'll withdraw the money and they go spend it in a crazy spree, and they don't have that money anymore. And now they owe $50,000. And then they also get charged with, I don't know if it's a felony, but I assume it's a felony. I think check fraud is a felony. So it's sad for those that truly didn't understand. On the other hand, if you're profiting off of some other entity's failing, even if it's a glitch, you shouldn't take advantage of that. There's an argument to be made that Chase is the largest bank in the world. Morality, and you could have those discussions on helping a random person versus the largest bank in the world. But still, theft is theft, and there aren't that many people in attendance at this webinar. I don't think any of you were expecting it, but if you need to hear it, I don't recommend attempting this infinite money glitch, because it won't work out well. Anyway, I have seen a couple, not relating to the infinite money glitch TikTok trend, which is classic check fraud. A couple questions come in that I can address. So the first one, I think, was when I was, or at least prior to, talking about Federal Reserve rate cuts. And the question said, how much do you predict the rate cut to be? And I had quickly mentioned it. I expect it to be a 25 basis point rate cut. They started last year when people thought that they were behind the curve on raising rates, that they should just get a 50 or a 75 out of the way and get it going now. It seems like Jerome Powell and the other members of the board are very much, they want to take things slow and not overshoot or not jostle the market. When these rate hikes happen, it actually affects liquidity and it actually affects how markets run. And you don't want to cause like runs on banks or cause trades to break in financial markets. So I wouldn't be surprised if their rate cut is 25 in September. And if they were going to do a 50, it would be 25, then 50 in the month after that. But it's perfectly possible that they do a 50 basis point rate cut in September. It's not out of the realm of possibility. It's also possible that they don't do a rate cut in September. But the broad expectation of the markets is 25 basis points, which is 0.25%. A basis point is 1/100th of a percent. So the expectation is 25 basis points in this month's meeting, and I agree with the market sentiment. I think that's what will happen. And you might see, for those of you that have high yield checking and savings accounts, you might see notices in the coming months after the rate cuts happen. Usually those flow down, not immediately, but they'll flow down to your checking and savings accounts. So you might get a notice that, hey, your 5% savings account or your let's say 4.5% savings account is now only going to pay 4.25%. There's nothing to worry about there. That's because the Federal Reserve is going to be changing the rates, and it's expected. You make a little bit less money, and that way you spend a little bit less. And because you spend a little bit less, hopefully it slows the markets down a little bit. Actually, I jumbled the words a little bit, and this next question helps a little bit. So how will rate cuts impact people's investment returns? So the majority of debt and such, at least for consumers, is negative debt. More people have debt than people have savings. So by cutting rates, I jumbled my words there. I said, you're making less money in your bank. In general, it will increase the amount of money that people have. So rate hikes slow down the economy. Rate cuts provide more money to people. So their credit card bill might be lower, their future mortgage might be lower, that kind of stuff. For institutions, companies, and such, they'll be able to go out and borrow at lower rates. So the expectation is when rate cuts happen, stocks go up, bonds go up. Now, that's more so the long term. I would expect, again, the next couple months, even if you have a rate cut, that stocks might fall. I'll also say that bonds are more predictable because more of them are directly related to interest rates. Stocks are definitely still related to interest rates, but there's a couple more steps to get there. For bonds, usually as soon as a rate cut happens, bond prices go up immediately. When bond prices go up, their yields, the interest that they pay, and is divided by their the bond price, the yields fall. So the yields will fall alongside the interest rates, but because of that, prices will go up. So those of you that have bond holdings in your investment accounts, expect those to rise. Of course, markets can be irrational, and especially in the short term, that might not happen. It's not a guarantee, but the expectation is 25 basis points this month, continuing cuts in the future months, and that will probably help your stocks and bonds. But more likely than not, the stocks have had the run up prior, because stock markets are forward looking, had the run up prior in the beginning of the year, so they might still fall. And then bonds, usually they still are forward looking, but less so. And I would expect that bonds will perform better. With all this said, I wouldn't try to be timing trading bonds versus stocks and hopping out of the stock market into the bond market. I wouldn't do any of that, but just some expectations and how these trends actually affect portfolios and such. All right. Well, those are some final disclosures. Thanks so much for attending. I didn't see any other questions come in, but hopefully I see you all next month. Hopefully I have good news, and hopefully you all have a great September. Go out and hike a little bit. It's beautiful weather. All right. See you, everyone.